Hello everybody, this is Harjinder and welcome to this video in which I will be going over practice questions for topic 4, investment in associates. So there are two practice questions that we'll be looking at. The first one is regarding Alpha Inc. On April 1st, 2001, Alpha Inc. acquired 50,000 shares representing 25% of the outstanding shares of Omega Corp at a price of $20 a share plus transaction costs of $10,000. The acquisition provided Alpha significant influence over Omega Corp. Know that when there's significant influence, you must use the equity method to report the investment. When using the equity method, the investment will initially be recognized at cost, which will include transaction costs. Any transaction costs are added. At this date, Omega's assets and liabilities equaled book values except for inventory, which was overstated by $40,000, and equipment, which was understated by $100,000. Omega's shareholders' equity consisted of common shares, $300,000, and retained earnings, $450,000. On July 31st, 2001, Omega Corp declared and paid a dividend of $1.20 per share. Omega's net income for the year 2001 was 1.2 million and was earned evenly during the year. Now that's important because our friend Alpha got significant influence on the 1st of April. So the equity method kicks in starting the 1st of April. So for year one, Alpha will only be able to claim 9 months, April 1st to December 31st, of Omega's net income as 25% of that number as its investment income. The shares of Omega Corp were trading on December 31st, 2001 at $22 per share. This amount, we don't adjust the investment to fair value, but if this amount is available, as is the case here, this is reported. This is not, so we don't adjust the investment account per se, but this is disclosed in the notes. Assume that Omega's inventory from April 1st was sold by the year end, so any fair value difference for the inventory cleared out, and that the equipment had a remaining life of 5 years on the date of acquisition. We are asked to determine the amounts that Alpha will report in relation to its investment on its statement of comprehensive income and its statement of financial position. The income tax rate is 25%. All right, so here we go. We don't need to calculate the goodwill here because there's no chatter about goodwill being impaired, etc. So we don't necessarily have to do it. So I'm gonna kick in. I'm gonna just dump right into the calculation of investment income. First of all, let's set things up. So Alpha will, on its statement of comprehensive income, be reporting its investment income from associate under other revenues and expenses. Alpha will report investment income from associates. Here is Omega. And on its statement of financial position, at December 31st, 2001, will report the investment in Omega as a long-term investment. So here's some calculations then. First of all, calculation of investment income. So Omega's net income for 2001 from now, because our friend Alpha acquired significant influence on April 1st, Alpha will start claiming its share of income from April 1st. Omega's total net income for the year was 1.2 million, and we're told that it was earned evenly during the year, which means we are able to prorate, right? We're able to prorate. So Omega's net income from April to December, right, was, and we can do the math, 1.2 million was for the full year. So for a 9-month period, that works out to 900,000. Okay, now this amount we have to adjust for fair value difference amortization, amortization of fair value differences. There is the fair value difference on the inventory, which we're told the inventory had been overstated by $40,000. So let's do a quick 2x2 as we learned in class to look at which way. So we can have assets and liabilities being understated or overstated. You need to remember that understated assets are positive. So understated asset is a positive, overstated asset negative. And then an understated liability would have been a negative, and an overstated liability would be a positive. So since the inventory was overstated, right? The inventory had been overstated by $40,000. Let's just write that out. Inventory was overstated. So the difference must have been a negative 40,000. And for the equipment, we're told the equipment was understated by 100,000. Now, this was on the date of acquisition as of April, so on acquisition date. Now, amortization in 2001, the inventory amount is completely amortized, $40,000. Now, for the equipment, right? So the inventory amount is completely amortized, $40,000. And remember, we don't change the sign. For the equipment, we have to remember that, first of all, the equipment has a useful life of 5 years. At the time of acquisition, which was April 1st, the equipment had a remaining life of 5 years. If you divide 100,000 by 5, you get 20,000. That 20,000 is for a full year. From April 1st to December 31st is not a full year. We need to keep in mind that we must prorate for the 9 months. So the amount of amortization for the equipment is 15,000. So the balance that remains basically at the end of year 1 is nothing as far as the inventory is concerned, and $85,000 for the equipment. So if we add things up here, we're looking at total amortization of the fair value differences for the year 2001. The total amortization is negative $25,000. Now, so amortization reduces income, but negative amortization, think of it as, so these are, debit would be a positive number would be a debit, negative number is a credit. So if we had a positive amortization amount, that reduces income. Negative amortization amount though will increase income in this case. So we are minusing, but since we are minusing a negative amount, we end up adding. All right, minus of a minus is added back. So we have $25,000 kicking in here. That's the amortization of the fair value differences in total. We could have shown a split, inventory 40,000 and then 40,000 and then equipment 15,000. We could have done that, or just directly um, put the 25,000 because we already have shown the computation here. And that's it basically. So we get a total of 925,000 for Omega's adjusted net income. And of this amount, Alpha's share is 25%. Alpha owns 25%. And so that works out to 231, 250. That's the investment income under the equity method. So 231, 250 is what will be reported as investment income from associate on the books of Alpha. Now, next thing to figure out is what's the investment account. So how do we do that? Well, for that, we have to calculate the investment account. So starting investment in Omega at cost, right? So the cost was we bought, or Alpha rather, bought 50,000 shares at $20 a share. So 50,000 shares at $20. And then you have to remember that the transaction costs of $10,000 are to be added, right? Transaction costs are capitalized. So if we do that, we get 50,000 shares times $20 plus $10,000 of transaction costs. We get original cost of the investment, $1,010,000. Okay, transaction costs will be added to the cost of the investment. To this, we will add the investment income, which we just calculated, 231, 250, and then subtract the dividend from Omega. Now we own 50,000 shares. Omega has paid a dividend of $1.20. Now, sometimes people make a mistake of prorating the dividend for 9 months. That's not how dividends work. Once the dividend is declared, we get that full amount. Right? So either you get the dividend or you don't get the dividend. There's never a proration of dividend. So 50,000 shares at $1.20 per share. That works out to $60,000. So cost of the investment, add the investment income, subtract the dividends, and we get 1,181,000. So that's the investment in Omega under the equity method on December 31st. And one. We could have also made a T account. This is just another way of calculating. So investment 1,181,000. So the rest of the information we didn't really make use of. We could, if we wanted to, have calculated goodwill and so on, but that wasn't asked. And second thing to remember is, even if you did calculate the goodwill is not reported separately because the goodwill just sits as part of the investment account. So unless goodwill was being impaired or anything, we don't really have to worry about it. The other thing is that there were no intercompany transactions resulting in intercompany profit. This was a fairly simplistic situation where it was just pick your share of the investee's income and then just take care of the amortization. So that, my friends, was practice question number 1.